All those consumer touching businesses are talking about a challenged consumer. The US markets are going to be more determined by the economic outlook and the earnings picture, rather than for the last 18 months, it was more focused on that no matter what came our way, if the Fed was going to be cutting rates, let's buy things. I think that sort of gig is up. We need some economic substantiation and earnings growth substantiation to pay these levels of the markets.
The latest inflation numbers came out today on Wednesday, August 14th. Annual inflation rate rose to 2.9%, which is the slowest since 2021. We'll talk about what this means for markets and the broader macroeconomic context with our next guest, Peter Boockvar, CIO of Bleakley Financial Group. Welcome back to the show, Peter.
Thanks, David, for having me on.
Let's talk about your initial reaction to today's CPI report, broadly in line with consensus expectations. Was this in line with your expectations?
Yeah, pretty much. I mean, I think the setup for this CPI was much different than what we've seen over the past year plus. And I say that because the bond market has already priced in about 100 basis points. This is prior to the number, 100 basis points of cuts by the end of this year and 200 basis points of cuts by the end of next year. So it took sort of the drama out in terms of the market moving potential impact of this number. And then on top of that, it came in just as we expected. I mean, we're on the downside of this inflation spike that we saw that peaked in the summer 2022 and headed obviously in the right direction. Question from here is, where does it settle out and does it stay there? Those questions have not been answered yet. People are spiking the ball. They're saying mission accomplished on inflation, but we've won the battle on inflation, I believe, but it's yet to be determined whether the war has been won. The war is won when it is sustainably lower, not just temporarily lower.
Well, we've had a few prints of continuously lower inflation now. To what extent, or at what point, Peter, will you say, can you conclude that the battle is being won?
Sustainable is the key word, and we're still decelerating. And I'm in the camp of not necessarily we're going to get a reversal higher in inflation anytime soon. I think inflation will continue to decelerate in the back half of this year because services inflation in particular will further moderate because of the rent component. I'm more in the camp that we're not magically going to fall down to 2% and just flatline there. That we go vertical, we come back down, and we just stay at 2% magically. I'm in the camp of more inflation volatility over the coming years. So let's enjoy this deceleration right now. When I say enjoy, I'm talking about from a market perspective because the average person is certainly not enjoying this rate of slowdown in inflation because they're still choking on the cumulative 20% plus rise that we've seen over the last couple of years. But for now, the deceleration is good. Question now, though, is that coinciding with a further deceleration in the U.S. economy? And I believe that is the case.
Yeah, let's talk about that. You actually made a tweet about exactly what you just talked about recently. You said a good visual of inflation CPI here, the spike above trend line, and why so many consumers are still not happy, even with the deceleration in price increases. What is this graph showing, Peter? What are we looking at right now?
Well, I just drew a trend line of inflation going back in 20 years, just so you can visualize the extent at which we spiked above that trend line. And when people are wondering why is consumer confidence muted, why is the consumer, particularly the lower to middle income consumer, still under stress, notwithstanding pretty good wage growth over the last couple of years? And that's because of this chart, because we jumped so far above in terms of the cost of living relative to the trend that it's a difficult adjustment to make that is causing a lot of spending behavioral decision making on the part of the lower to middle income consumer and even parts of the higher income consumer that sees prices and remains still with sticker shock.
You think with 2.9% inflation, consumers will be comfortable going back out and spending money again? Will consumer spending tick up is basically my question at current inflation levels?
No, because it's still rising. It's just rising at a slower rate of gain. So yes, it's good that inflation's decelerating, and we'll see, like I said earlier, to what extent and how sustainable it is. but the consumer is still very stretched. And you don't have to hear that from me. You listen to all the companies that sell and touch that consumer, whether it's a retailer or a consumer products company or a restaurant. Yeah, I listen to countless earnings calls, whether it's stocks that we own or other companies that I want to hear what they have to say. And this doesn't feel like a 3% economy. This feels at best maybe a 1 to 1.5% type economy. And all those consumer touching businesses are talking about a challenged consumer. Now, the higher income consumer is certainly more immunized from the rise in inflation. They're experiencing the benefits of a higher stock market. They're benefiting from a 4 to 5% interest rate on their savings. So there is a delineation between different parts of the U.S. consumer. But I think in the aggregate, consumer spending is pretty muted, I believe, overall, outside of maybe travel and leisure and a few different spots in the economy, like cruising, for example.
Before we continue with the interview, I'm going to tell you about another way you can invest your Bitcoins and store them safely instead of using a traditional wallet or an exchange. Consider an IRA. Today's sponsor, iTrust Capital, is one such IRA that offers 35 crypto assets and the lowest trading fees in the crypto IRA space at 1% only. And being an IRA, it also offers unique tax benefits. If you'd like to get started and learn more, click on itrust.capital/David in the link down below or scan the QR code up here. If you're over 18 and you want to open a new account with cash or roll over an existing account, you can do so using my referral link. And if you use that referral link, you'll get $100 in signing bonuses. So I've heard this argument before. This is an excellent point. Inflation is decelerating, but all that means is that the rate of change of prices is still going up at a slower pace. So here's the counter argument to this is that, well, look, the other thing that we could have is deflation, which is lower prices, outright lower prices. But what does that imply? Perhaps that implies lower wage growth as well. Perhaps that implies a much slower economy, which could portend layoffs. So it's kind of the lesser of two evils. Which would you pick? Lower inflation or outright deflation?
Well, I don't think that the economic reality is that simple. The history of technology is deflation. And what has that allowed? It has allowed us to do the Zoom call on a laptop that probably cost me $2,000. Sure. Where if this same laptop 30 years ago went up by the 2% target of the Fed, it would be probably a $7,000 laptop. So it depends on what kind of deflation we're talking about. Deflation in the price of goods is because of technology, because of production efficiencies. Deflation in something you own, that could be bad. Deflation in a piece of real estate where you have debt coming due, that could be bad. Deflation in the rents that you collect, that could be bad. So it's much more nuanced than whether deflation is good or bad. Deflation bad, inflation good. It all depends on what we're talking about. Inflation always goes up. And in fact, that's really mostly driven by services inflation. Services inflation is never transitory. It's really the good side of the equation because of the factors that I just mentioned, where that's typically you don't see really any price growth, outside of the cyclical spikes that we had just experienced. It's always services inflation that really brings the aggregate number always higher. So the debate on inflation going back 100 years is not is inflation going up or down, it's going up, but what's the rate of change of it going up?
I like to share with you this chart. It was brought to my attention courtesy of Rosenberg Research. So this is a federal funds rate going all the way back to 1955. As you can see here, every single time, or almost every single time after the Fed funds rate has peaked, immediately following a pivot, we have an Ember designated recession. So my question is this time going to be different?
Probably not. And that is also very intuitive too, as the Fed cuts interest rates as the economy slows to try to head off a recession that they previously had caused because of their rate hiking cycle. So that's typically what happens. And I do think that I've been worried about it the last couple of years, is not an event reaction to the very sharp rise in interest rates, but something more akin to a death by 1,000 cuts, because not everyone's debt comes due on the same day. Not everyone is immediately affected by the rise in interest rates. If you were a baby boomer that has no mortgage, or you have a 3% mortgage rate for the next 20 years, or if you're, as I said earlier, getting 5% interest income on your savings, you're not necessarily hurt by the rise in interest rates. In fact, you're actually helped by that higher income on your savings. And then on the flip side, if you have debt coming due, not all that debt comes due all at the same time. So that's what I've been worried about. And I feel like we're reaching the point where, the economy is beginning to soften further through that death by 1,000 cuts. And we're seeing that with respect to the labor market sort of being that last leg. Now, the question is, okay, let's just say we go into recession or we experience a little growth, even a malaise type situation. What could sort of trigger us into a more harsher economic downturn? And I think a lot of that will have to do with where the stock market goes. Because as mentioned earlier, as we all know, the higher income consumers much better off. Well, if the stock market rolls over for whatever reason, whether that's an earnings challenge or so on, well, that can then affect negatively in terms of the wealth effect on higher income spending. So that's something that we have to also pay attention to as sort of a moving part to where the overall economy goes. I mean, to me, what's keeping the U.S. economy on its shoulders is that higher income consumer. It's spending on AI. It's any beneficiary of all the government spending, particularly healthcare, and the benefits of the government incentives for infrastructure and manufacturing facility build-outs in EVs or semiconductors. Outside of that, I don't really see any strength in the economy. And in fact, I see contractions in other parts of the economy.
So if the economy is being propped up by high income individuals and earners, and a lot of the wealth, by the way, comes from the market's investments that they've made, can we make the argument that the stock market could lead the economy this time? Because if financial markets crash or even suffer, potentially the wealthy people may start spending less because of the wealth effect, because their wealth is going down. Can you make that argument?
That's what we have to watch out for. I mean, we have to keep in mind, pre-COVID, the two prior recessions were driven by declines in asset prices. The first one was the decline in tech stocks that led to a collapse in capital spending. And then the second one, of course, was the decline in home prices that led to a collapse in the collateral backing all these loans and so on and so on. So yes, where asset prices go does have an important impact on the economy. But this time, it's more than just asset prices. It's that small business that can't get a loan or doesn't expand because they're having to pay 10% on their cost of capital, or it's the multifamily land operator that after building a lot of multifamily units the last couple of years is not going to build anymore. So there's no activity that's going to take place in the next couple of years after what's being built now is done. So it's a combination of factors. But to my point earlier, where asset prices go will determine if the economic moderation we are seeing, that I believe we're seeing, is mild or something more deeper.
Well, let's talk about the small business. Will they still face potential liquidity issues or capital raising issues if the Fed starts cutting rates, and we could start seeing consumer interest rates go down as well?
Well, we hope not, as we sort of take the edge off the spike in interest rates, and maybe it becomes easier to service one's debt, and it maybe becomes easier to get a new loan. A lot of that will, at least for small, medium-sized businesses, will be dependent on the banking system as opposed to the capital markets. I mean, the person that's got 10 restaurants is not calling up Goldman Sachs and saying, okay, let's do a leverage loan together here. They're having to call their regional bank and hoping to get a loan. And if they get that loan, they're going to have to put a personal guarantee and so on. So we're going to need to see, coincident with the drop in interest rates, we're going to need to see some easing of lending standards. Problem is though, if interest rates are falling because growth is slowing, banks will still be reluctant to lend in that slowing economic environment. So it's sort of a chicken and egg thing that we're going to have to keep our eye on here.
Let's talk about the markets. So stock markets, the S&P and NASDAQ are a little changed today following today's CPI report. I guess that falls broadly in line with most people's expectations. I want to show you this chart here. This is the S&P 500 overlaid with the Japanese yen. and the yen is the purple line here. Year to date, we've seen a close correlation, not perfect, and the question is whether or not this correlation is going to hold. What's your take? Certainly, if we go back, there's been very little correlation or not inconsistent relationship, but that it certainly looks to be stronger this year. What's your take on this relationship here?
Well, certainly referring sort of to this yen carry trade
Yeah.
that has had a major unwind, as we know. The extent at which is left is unknown. I've seen estimates that there's maybe 25% left or 50% left, whatever. A lot of it's been taken off, but it is a factor in markets. I think the relationship is going to be somewhat more differentiated going forward. I think the U.S. markets are going to be more determined by the economic outlook and the earnings picture, rather than for the last 18 months, it was more focused on, okay, the Fed's slowing down their rate hikes, the Fed's done raising rates, and now we're going to shift to rate cuts, that no matter what came our way, if the Fed was going to be cutting rates, let's buy things. I think that sort of gig is up, and that we need some economic substantiation and earnings growth substantiation to pay these levels of the markets. Therefore, what happens with the yen from here may have more of an influence on the Japanese market and other parts of the market. That's not to say that that if the yen further weakens, and let's just say it takes the dollar down against other currencies as well, well, then we have to have a debate. Okay, the dollar's weakening, or we're going to start importing inflation. Is commodity prices going to get a lift? Is that going to reverse the inflation picture? So we can't ignore the relationship because everything is intertwined in some way. But I guess I would say the tightness of that relationship, because of this carry trade unwind to a large extent, maybe that sort of splinters a bit, that relationship.
Well, the markets have rebounded since last week's dramatic fall and spike in the VIX on Monday. Can we talk about potential catalysts for an asset price reversal going forward?
Yeah, well, I think it's the earnings picture. I think one of there are two things that really we need to take note that's happened over the past couple of weeks. Well, actually, probably the past month now. Number one is on this whole AI hype trade, the markets are now separating out the direct and immediate beneficiaries of all this AI spend, that being NVIDIA and all the infrastructure players, and those that are spending all this money. Because people are realizing for those that are spending the money, those hyperscalers, the Metas, the Googles, the Microsofts, the Amazons, it's an expense. It's a major expense to spend all this money. And while the benefits of that spend may be all well and good, that all well and good is not anytime soon. And right now, all that spend is an expense that could be, sort of a drag on earnings growth. So I think that was a major realization in the market. And then even before we got these earnings reports, it was a Goldman piece, and others were beginning to question whether these companies were going to see a suitable rate of return on all the spend that for each of these companies was $15 to $20 billion per quarter. Then the second thing is, and it was the Thursday jobless claims, it was the Friday payroll number of the July payroll number, those 2 days where it seemed that the market was shifting its focus where disappointing economic news would be disappointing for the markets. Whereas for the prior year and a half plus, disappointing economic news would be good for the markets because that would imply Fed rate cuts. I think now we've already priced in 200 basis points of rate cuts over the next year. Now it's sort of put up or shut up for the economy because most of the time when the Fed is cutting interest rates, that is not good for stocks rather than being good for stocks. Usually it's good for stocks in the lead up to it, but if we get a recession, that ends up being negative for stocks.
The 10-year is down dramatically today. Well, not dramatically, 1%. So it fell 1% today. It's now at 3.8. It's been falling ever since the beginning of May, basically. So where is this headed from here, you think, given that inflation is at 2.9% currently?
I think it actually stops around these levels. And I say that because the 375, 385 10-year yield level was the launching pad for the July 2023 spike to 5%, which coincided with the Bank of Japan basically getting rid of yield curve control. To me, that was the catalyst to get that move. So now I believe, in terms of yield, this is where there's major support. And I don't think that the worries about U.S. debts and deficits is over. We definitely have had a temporary rally. I believe that once we hit 5%, that was sort of a capitulation move. But I think we're in a bond bear market that has years to go. I don't think it just ends in a couple of years. In fact, history doesn't tell us that bond bear markets last only a couple of years. Just as bond bull markets last for many decades, the previous one lasted 40 years, bond bear markets can last 15 to 20 years. Now, I'm not saying that's going to happen this time around. I just think that longer term rates, so separated from short term interest rates that are bullied by the Fed, longer term interest rates are still going to remain relatively elevated. On a historical basis, they're not elevated, but compared to the 15 years leading into 2022, they are more elevated. And I would not be surprised if we had another trip back to 5% in the 10-year in the next couple of years.
Can we make the assumption then that the 10-year is no longer tracking inflation or inflation expectations?
No, I mean, I think it is. I think that the decline in yield has certainly been helped by that. I just think that you also have, unless the supply and demand laws have been repealed, I still think that $2 trillion U.S. budget deficit that can go to $3 trillion in an economic downturn could have an upward influence on long-term yields, even in a scenario of moderating growth and inflation.
And just to clarify for the audience,
dynamic that we've never been involved in. Usually for the past 40 years, long rates have followed growth and inflation. But I think this time we can't ignore the possibility of, like I said, a bond bear market and debts and deficits that for the first time actually do matter.
Okay, so let's talk about that. So just to clarify for the audience, when you're talking about rising deficits, are you assuming then that a lot of these deficits will have an inflationary impact? Is that what we're discussing here?
Well, yes, an inflationary impact, or sort of keeping a bid under inflation, so to speak, and also just a supply-demand imbalance. One of the major factors in the U.S. Treasury market right now is the lack of participation on the part of foreigners. 10 years ago, they owned about half U.S. Treasury market. Today, they only about 30%. So we've had to find buyers elsewhere. The Fed obviously was a big buyer. Now you have the U.S. private sector, which, because of plus signs in front of yields and much higher than pre-2022, they've been also financing the U.S. budget deficit. But like I said, if the deficit goes from $2 trillion to $3 trillion, if the deficit relative to GDP goes to 6 to 10%, are we going to be able to find enough buyers? And historically, we always do find them, but are we going to in this potential scenario, which I think is a growing likelihood if the economy continues to slow and tax receipts falter?
The options adjusted spreads for corporates are still relatively low. Do you see any imminent liquidity crisis or event on the horizon?
Yeah, just if the economy slows, then that stretches cash flows. And we're still sort of transitioning into this higher rate environment. Big companies, pre-2022, they did a great job in terming out their debt. But every year that goes by, that low-cost debt comes due and they need to refinance. They'll be fine. We're not talking about extraordinarily high interest rates for bigger companies. But for small and medium-sized businesses, the average cost of capital is about 9.5% if you look at the NFIB Small Business Survey. And they're CCC credits that are paying 13 to 14%. So if the economy weakens, cash flows get crimped, that's expensive capital that they need to finance and may have a tough time doing so.
So I guess my question, and a lot of other people are wondering the same thing, what's still propping the stock markets up if the economy is deteriorating and inflation is signaling perhaps a slowdown?
Earnings growth was pretty good in the second quarter. Now, granted, that is often easy comparison because I think in the second quarter of 2023, earnings were down. So it's not saying much. But I think, the AI trade is still there. I mean, these big cap stocks are still holding things up. But, and maybe I'm more worried about the economy than others. I'm just, from what I see and listen to in terms of corporate America, there's a very muted pace of business activity from what I am hearing and seeing. But the markets are held up by hopes that the Fed is going to cut rates, and they will cut rates. And what are people trained to do? They're trained to buy stocks when the Fed is cutting rates. That's why we're reaching an important point of whether we priced in all of those rate cuts, and now does the market transition to focusing more on the economy and earnings that I am becoming a bit more worried about.
What, in your opinion, are the biggest risks not priced in currently?
I think it's that further deceleration in growth and earnings.
Okay.
That's what I don't think is priced in. I think people just think that the Fed's going to cut rates and everything's going to be fine, and that they're going to thread this needle, and inflation's decelerating, and growth is going to hit a soft landing, and the Fed's going to cut, and everything's going to be fine. I would love it if it were to happen. We're long, particularly small mid-cap stocks. I'm just a bit more skeptical that this is a possibility.
So let's finish off here on asset allocation. So you think we're entering a bond bear market, or we're already in one?
We're in one. We're not
in one. Sorry, yeah. Let's rephrase that. We've been in a bond bear market. It's going to last. Okay. So what do you like then? You mentioned small caps. You're long small caps right now and mid caps.
Yes, I think I'm hoping that the drop in short-term interest rates could be a help to small and medium-sized businesses because of the floating nature of a lot of their debt, that you could get some easing of those financing costs, plus the divergence between the big cap growth stocks and everything else has been so extreme that I'm hoping for some reversion to the mean. Commodity stocks have gotten beaten up, but I remain a bull on commodities, particularly energy. One commodity that's not been beaten up has been gold, and we've been very bullish on that, and silver, and continue to be, in addition to the miners. And ag has been really beaten up. Corn prices below $4, soybeans below $10, fertilizer stocks that have gotten killed, and that are highly correlated with those crop prices. I think they're really interesting opportunities, and we happen to own some of the fertilizer stocks that I like there. And also, we also invest internationally, and I could be one of the few bulls on, and I'm going to specify this, the Chinese consumer. Chinese consumer is under a lot of stress. Home prices are going down. That's a big drag since a lot of their assets are there. But I would not count out Chinese consumer, and trying to find beneficiaries of that spend. And not just the Chinese consumer, it's the entire middle class of Asia that's growing. You have half the world's population there. So I'm very bullish on a growing middle class in Asia, and we own stocks that benefit from that.
Let's follow up with your work. Very interesting analysis today. So where can we learn more from you and Bleakley Financial?
So in addition to being a wealth management firm and as the CIO, where people can learn more about us at Bleakley.com, I write on Substack a daily, a few different pieces each day, talking about the markets, the economy, different companies, and things that I find relevant. So you can find me on Substack by punching in my name and trial it out.
Excellent. Thanks very much, Peter, for your time. Appreciate it.
Thanks, David, for having me.
Thank you for watching. Don't forget to like and subscribe.